So, in today's video, I'm going to talk about a neat little trick that allows banks and other organisations to turn losses into profits. Sounds like financial alchemy, and it is. It's a great example of the rules intending to solve a problem and actually creating a much bigger one. Now, here's a statistic you might find a little bit scary. I certainly do. If I asked you to guess what proportion of Bank of America's last 4-quarter profits were generated by accounting sleights of hand that have nothing to do with cash flow and nothing really to do with their core operations, what would you guess? Well, the answer is 46%, so call it half. And if you look across the other big 3 banks reporting in the 3rd quarter this year, anywhere between 20 and 50% of their profits come from the little trick I'm about to show you. And this trick enables banks to almost make up their profit figures. For example, without this little trick, Bank of America would have recorded something like a $2.3 billion loss in the 3rd quarter. With it, it reported more like a $340 or so million profit. So whatever it is, it's a pretty neat trick. It's not just used by banks, but banks are the current big users of what I'm about to describe. So here we go. What is it? It's called loan loss reserve adjustments. Now, don't switch off the video right away, because the jargon conceals something quite simple in a way. Here it is. You're a bank, okay? Here's how you go about it. You're a bank, and your objective, like most companies reporting to the market, is to show nice, smooth profits. You want your profits to go steadily upwards, no shocks for investors, no nasty surprises. So you're going to use a little accounting trick to make sure that happens. And here is the trick, okay? As a bank, imagine you have lent £1 million 10 times to, slightly artificial situation this, some people living in the same part of a town who want to buy a house. All right, so they've gone out and basically bought £1 million houses at the current market valuation using £1 million loans from your bank. And there are 10 of them, all right? So as a bank, you've lent £10 million. Now, that £10 million is a receivable. As the bank, you expect to get that money back at some point, so it sits as a nice £10 million asset on your books. All right, £10 million owed by hopefully mortgagees who in the meantime will pay interest. That's how you make profit as a bank on the 10 million and will also pay you back. Something goes wrong. 6 months later, one of the people you lent £1 million to starts to not repay interest. Okay, so now as a bank, you're getting nervous. Wait a minute, one of those 10 mortgages is starting to not perform. And then a few months later, okay, in trouble, having lost their job, that person turns around and says, I can't pay the mortgage anymore, and I've got to sell the property. And imagine they sell what was a £1 million house in a difficult market for half that amount, £500,000. All right, so suddenly, as a bank, you've got 1 in 10 of your mortgagees not paying interest, not able to pay you back. So the property's sold and realizes, in my little example, only half of the amount it was supposedly worth when you created the loan in the first place. Now you might say that's a little bit artificial, but I want to make a point here. What do you do next? All right, well, you're going to have to write off, as a bank, half of that mortgage debt, all right, because your man who's got the mortgage ain't going to pay you back. Okay, so there's an actual loss, a hit. Okay, that's going to involve writing down the original 10 million asset by about $500,000, let's say, taking a hit through profits. But that's not what I want to get to, all right? That's the obvious bit. What do you do with the other 9 people, very, very similar, who went through similar credit checks, who've still got £1 million loans, are still paying the interest at this point? What do you do, okay? Do you revise your view of their creditworthiness and therefore the value of the remaining asset on your books of, say, near 9 million, okay? So do you make some sort of adjustment for the remaining asset on your books for those other 9 mortgagees? Okay, do you ignore the problem? Do you just say, well, the chap who couldn't pay his mortgage is a one-off, so we'll deal with him and ignore the others? All right, you treat him as what they call an impaired loan and the others as non-impaired and just leave them sitting in your books. Okay, or do you do something in the middle? Do you say, oh, well, hang on a minute, 1 in 10 of the people we lent money to has struggled, so maybe we need to provide for, I don't know, 10%, 20% of all the other loans on our books, just in case. Okay, now that process sounds quite sound, Okay, so a bank sitting down, going through its loan book and saying there are some problem loans, all right? Loans, remember, in a bank's book are assets. They're expecting the money to come back in at some point, okay? So what they're doing sounds perfectly sensible. They are going to make some kind of provision, set-aside amount, against the possibility that they don't recover all the money they're expecting to. And the way that would work is as follows. If you've got a £10 million, let's say, asset in your books, that's, in my first example, 10 mortgages worth £1 million each, and you decide that actually, given the economic conditions and so on, a proportion of those are not going to be recovered, all right, then in very basic terms you might say, well, I'll make some kind of provision. I'll knock, let's say, 2 million, 20% provision off my asset to bring it down to more like 8 million in the books, and that reduction in the value of an asset creates a hit to profits of 2 million, right? Now, you might be saying, well, so far, so what? All sounds very prudent. Sounds like banks are doing their best to work out who's going to pay them and charge profits with any amount they don't expect to recover in the future. Here's the trick, okay? Here's the trick. If it turns out you've been a bit too cautious here later, you can reverse effectively what I've just done here. So if it turns out that having charged profits, okay, taken the hit of the 2 million loan loss provision, as it's called, if it turns out a few years later you're a bit overcautious, basically what happens is no problem with these mortgage loans. In fact, they're all paid back clean, or you estimate there's no longer a problem with these mortgage loans. You can actually write back the 2 million. Okay, I won't go into the technical accounting way that's done, but you can basically say, well, actually, we were a bit overcautious here, so the asset really is worth more like 10 million, and we can put 2 million back through profits as a credit or as income. All right, now, the objective is sound enough. What these banks are doing, in theory, is saying, in the bad times, we need to make provisions against the fact that people won't pay us back. And if it turns out we were a bit overcautious a few years later, we'll write back those unnecessary charges to profit back through our income statements. You might be thinking, well, sounds okay so far, but here's the scope for playing around with the numbers, right? Here's the sort of thing that banks can get up to. Because ultimately it's them that decide, subject to some accounting rules, how much they provide against problem loans, problem assets, and how much they write back later. So imagine, here's your situation. Let's just do 3 years. 1, I'm making up the numbers here, 2, 3. And here's your profit before your loan loss provision, LLP. All right? And then I'm going to put a loan loss provision in, and you'll see the scope for playing around with profit numbers here. So let's say a bank is looking at a profit number in year 1 of 150 million. This could be dollars or sterling. Okay, profit in year 2 of 100 million. And a profit in year 3. This is before we do any of that messing around I mentioned with problem loans, problem assets, problem receivables of 80 million. That's not looking good. All right? Our core operations are gradually slowing us down, 150 to 100 to 80. So how can I use what I just said to reverse the picture? Literally reverse it. Turn declining profits into the opposite. Here's what I do. I convince investors and the auditors and the regulators and so on that what I need to do is put a loan loss provision of 50 million in year 1, which reduces the overall profit, that's a funny little symbol, to 100 million. Now this was happening during the credit crisis. Okay, banks would say, oh, got to be careful. Okay, all these loans we've made, all these mortgages we've made, a whole load of them are not going to come back. We're not going to get 100% back, so we need to start making provisions. Okay, we need to start writing them down. Okay, taking hits to profits, being prudent, being cautious, looking ahead. Okay, and then of course what happens is, so you've got that booked. What happens is, a couple of years later, the banks start saying, well, actually, we were a bit over cautious. We don't really need all that 50 million provision. It turns out not as many mortgages are underwater as we thought they would be. More people are going to pay us back than we thought. So here's what you do. Maybe you think, well, actually, we don't need the full 50 hit to profit, so we'll reverse 10 million of it into year 2, which creates an overall reported profit of 110 million, and we'll reverse the other 40 back into profits in year 3, which brings that up to 120 million. And hey presto, as if by magic, having played around with your loan loss provisions, you've turned falling profits into rising profits. All right? And this line here has nothing to do with cash flow. No cash is coming in or out of the business that relates to these numbers. Okay? And it's got very little to do with your core operations, which is what's happening here. All it does is allow a bank, and it's not just banks, companies can do this with stock provisions, receivables and so on, but I won't go into that here. It allows them to change the face of the profit and loss account, literally change the view taken away by an investor of how much money they're making. And in the case of Bank of America in the third quarter, they actually turned what would have been a massive loss into a profit simply by reversing, we're talking sort of more than 2 billion worth, not the 40 million I've got here, simply by reversing out previous provisions against dodgy loans. All right? So, what does an investor do about all this? I mean, you don't have to follow the minutiae of what I've been saying or worry about the accounting rules, but what do you need to do as an investor? And the answer is watch cash flow, right? Because you can't play around with cash flow like this. Okay, this is all profit and loss account entries. So while it's tempting to look at profit statements, profit announcements, that's what the bank wants you to focus on. The takeaway from this video, and I cover it in another video, what is cash flow? Okay, but the takeaway is always check the underlying cash flow statement. Make sure you're happy with the quality of a firm's profits, and that is the extent to which they're backed by cash. Okay, because otherwise, if you're a bank investor or an investor in companies that play around with their provisioning, you can be duped into thinking the picture is rosier than it actually really is. To download this free video to your favourite mobile device, find us on iTunes by searching for MoneyWeek. And the entire video archive is also available free. Just visit moneyweek.com.